Good evening, everybody, and welcome to the fourth class in our Getting Started series. This is our stock selection panel. We're going to talk about real stocks in real time. Our panel features Suzi Artzberger. She's the Director of Information Technology at our headquarters office in the Detroit area. Charlene Hansen, she's a former director with the Kroger Company, executive with the Kroger Company, and she's now working with one of our model clubs up in the Traverse City area. She lives in the lovely little town of Elk Rapids, which is about 15 miles outside of Traverse City. That's my mug, third from the left there, and I'm a former high school principal, and I've been volunteering for Better Investing now for about 30 years, so you can guess that I'm older than anybody else on the panel.
And a magical mathematician.
Manning. That's Ann Manning, a director from our Houston chapter. And Ann has been helping us out at our roundtable sessions. She serves as a kind of a regular fill-in when we're looking for somebody to fill in for somebody that can't make one of our roundtables. And Ann's turned into quite a stock picker. We really respect the way that she decides to choose a stock and then the presentations that she makes. Mark Robertson is next. Mark used to work for Better Investing, and recently, in the last 20 years or so, he's the CEO of an independent website called Manifest Investing. And Manifest co-sponsors these programs that the Mid-Michigan chapter does, and we're so happy to have Mark on our board of directors as a volunteer as well. And at the end is Matt Spielman. He's also a director with the Houston chapter. His ties to us go deep, however, as he helped form one of our model clubs up here in mid-Michigan. Matt used to work in the auto industry in the finance area, if I'm correct. Am I correct in that, Matt?
Engineering and information technology.
Okay, and Matt is really a great digger into finding new stocks that you've never heard of before and then making the case for why you should buy them. So listen very carefully when Matt speaks. He usually makes a lot of sense. This is a panel that is all volunteers. None of us are professional stock pickers. We're not stock analysts by profession or by trade, but we really enjoy putting stocks into a portfolio and following them. And we're all Better Investing members, hoping to make your life a little bit easier as we go through this exercise tonight. Next slide, Mark. We're going to talk about real stocks in real time. So again, we'll try to mention when we own the stock, how long we've owned it, and we'll try to let you know if we think it's a core stock or a non-core stock. Basically, however, everything we're doing is for educational purposes only. The views that are expressed by our guests and our participants are their opinions. We ask you to do your own analysis, form your own opinions, and then make the decision to buy, sell, or hold for yourself. Don't just take our advice and go out and buy something, or even worse, take our advice and go out and sell something. Make your own decisions. If you'd like to become a member of the Mid-Michigan guest list and get correspondence about the Roundtable, which is our monthly stock program, drop an email to nkavula1@comcast.net. That's my wife, and she'll help you get onto the Mid-Michigan guest list. And you'll get one email a month from us, and it'll just tell you when the next roundtable is going to be, and it'll provide a link where you can register for the roundtable. If you'd like copies of the slides tonight, then drop a note to Mark R. at manifestinvesting.com. And my email address, if you have questions or would like to ask a question or make a comment about the program, is kavula1@comcast.net. Change the N to a K and you'll have my email. And Mark and I both love to correspond with our audience, and we really like to make it so that we can interact with the kinds of things that you'd like us to answer and to talk about. So without any further ado, let's get this stock panel underway. we're going to go through some history real quick. Here's the stock panels that we've been doing now since basically since the pandemic began. Mid-Michigan did some substitutes for the BI convention on 2 different years, and then we did run a convention in 2022, and a lot of us were on that stock panel at that time, and we've been on the stock panels off and on over the last 5 years. Here's the 12 best performing stocks, so you can get some pretty decent picks. Look at that annual return column. That's the 3rd one in from the right there. You can see the annualized return up till maybe yesterday, on these stocks, and you can see when we started keeping track of that return. The yellow background means that either the company has been bought out, or it's been reformed, it's not public anymore, or many other reasons, or we have closed the position because we decided that the position, we wanted to kind of freeze the return at the place that it was. And that goes to Stone Company and Immunogen. Here's the 12 best performers, but we don't want to give you the opinion that we're going to give you that many great ideas. Go on, Mark.
There are no guarantees. These are the ones you talk about at the hair salon or the barbershop.
Yep.
But in the interest of really attempting to learn from our past decisions, let's just spend a moment going through. This is back, think back. This was only 3 or 4 months into the pandemic. And one of our better results of all time, you can see that the 28% beating the market by 10%. Again, that's over about a 4-year period. And some pretty decent results here. So that's just an example. Doesn't always work out. And again, we try to learn even from the ones that are dripping in red ink. Now, back in November of 2020, I made the first of a number of magnificent presentations on emergent biosolutions. And you can actually go back and listen to them. I mean, some of the best stock presentations in the history of investing. And they don't always work out, right?
Yeah, but watch the bottom of the charts for the next couple of years, folks.
And there's probably a diversification lesson in here too, but Pat Donnelly shows up near the top of this list quite often, as does Suzi. Here's the next session, May of 2021. There's Matt with his Green Brick Partners. And yeah, I did manage to lock down the last 2 spots in this roll call. I do cry myself to sleep at night every once in a while. And this was November of 2021. And yeah, just basically demonstrating how stubborn I can be. Another great presentation. But in general, mixed results. But what we are finding is that we're running a couple percentage points ahead of the market when you take in total. Back in 2022, we did return to a live national convention in Dallas. So that's the numbers you see for June 2022. And then last year, about a year ago now, we had another virtual conference. And I would like to point out in the most current stock panel, who was in number 1 there. I do own that one and have owned it for a few years.
You know what they say about blind squirrels and nuts, don't you, Mark?
Well, you know, in that Duckhorn portfolio, for those that aren't familiar, that ticker symbol NAPA should give you a hint. That one should have worked out better too. That was a fantastic presentation.
Hey, Mark, a good question here. Which benchmark are we talking about when we look at these charts?
The benchmark is generally always the Wilshire 5000. Total return for the Wilshire 5000. Okay, so that's our history. And you can see that it's mixed, but in general, you take it all in combination, pretty good stuff. We have been doing pretty well lately. So with that, I think we can go into our presentations, Ken.
So let's not have any further ado. Suzi, we're going to let you lead the presentation off with Expel Incorporated.
XPEL Incorporated, ticker XPEL. And I'd like you to take a look at those lines there. This is one that shows up on our, I think it's the A-list stock screen, or it could be the small company screen. I forget which one. So I've been looking at it for quite a while. I do not own it. It's in my watch list. We see some straight lines. So click, please, and we'll bring up the what they do. So trade's about $59. It's in the consumer cyclical auto parts industry, Morningstar Financial Health grade of B, and they are a big company that does, they're a small company, sorry, they're a small company, but they're a leading provider of protective films and coatings for the autos industry, particularly those people who have bought an expensive car and want to protect it, and there'll be a picture later. So they have recurring revenue in the form of software and cutting technologies. So these cutouts for the cars of the films can be done right in the shop. They work all around the world with their products, and the majority of the revenue is from the United States. So click one more time again, and I want to take a look at the sales growth rate over these past 10 years has been 34.2%. However, note from the price bars that the company has only been trading for about 6+ years. So that previous data is going to have been part of some of their filings. So it's a new company. It's a small company. And we'll get into some of my feelings about this company in a little bit. But I like to present something that's probably new to the community that is intriguing to me. Quarter over quarter, they've had sales of 34% increase and an earnings increase of 43%. And so I'm intrigued at this point. So let's move on. I did some research. These next couple of slides are from the company's investor presentation. The leader in protective films. Not too many people do what they do. Their number one product is automotive paint protection films. I'd never heard of this. Did some research. I had a father-in-law, he's since passed, God bless him, but he worked for DuPont, and he was in charge of the Wrap Guard product, which is the opaque kind of sticky repositionable films that go on cars for transport, so they don't get stone chips and such during transport. That's not what this is. You can see in the bottom little picture, perhaps, that there's a guy putting this clear plastic film over the front of a vehicle, and this is a product that is mainly utilized by detail shops and sometimes by auto dealerships, where you can get your car protective film coated before it even gets delivered to you. So that's their number one product. Number two, they do automotive window tints and window films. So yes, click next slide, please. So the paint protection film, it's cut to fit just a huge variety of different vehicles. This is supported by they call it DAP design software. And if the shop uses this, then there is a fee actually for each cutting and for the software itself. So that's another little revenue stream. Automotive window films, these are the darkening films that are used in places where it gets very hot, like your Arizona, Texas. We don't see them too often in Michigan, where I live, but sometimes you do. And then they also make a ceramic coating product that you can apply on top of the paint protection film or right on the painted surface. So again, if you're getting the sense that people who really love their cars, they take it to a detail shop and get this sort of treatment done to it, then you're on the right track. So next slide, please. Now they do get into the non-automotive space, and I will say that their home office and window film category is the next largest. It's not trivial. We'll talk about some numbers later. Antimicrobial films, things for touch screens, on various products, and surface protections like perhaps on phones or stainless steel solid surface countertops and so forth. So that's what they do. And they've been making a decent living at it. They do most of their business. It's about 52%. China is growing pretty rapidly. 2 years ago, it was about 10%. Now it's 16%. And they distribute or sell and distribute the products through these independent installers, new car dealerships, third-party distributors. In fact, Tesla uses it on some of their products, not all of their products. Company-owned installation centers, and then Canada, they've got this Protex franchise that they'll also sell through, and they will also sell it online. They do not sell to retail people like you and me. I tried, and they're like, nope. Okay, next slide. Taking a look at evaluate management, pre-tax profit on sales have been ramping up or inching up, however you want to think about that, but they're trending in the right direction. Their margins are increasing. Return on equity had a little bump there in 2023 down, but I'm not terribly concerned. And we're, you know, they're 6 years into their public company journey, so the 31% doesn't bother me a bit. Debt to capital, they've always carried some debt, and it rose to its peak in 2021 and is trending in the right direction at this point, down to 16.7%. Their current ratio is acceptable. Their quick ratio, which is a lot more strict, conservative, I wish were a little higher, but they definitely have enough money, as shown in their interest coverage, enough cash flow to pay the interest on that debt. So I'm feeling still sort of good about this. Let's take a look at columns D and E, where we're looking at PEs. So these are not small PEs. We have some years, particularly in 2021, when E was a little low and PE looks a little high. So as a small company who's in a really robust growth phase, if you've been hanging around, I heard a presentation about the business cycle of the company. We're just kind of getting into the phase where PEs start to make sense. Regardless, their current PE is 31 and their 5-year average PE is 41, which tells me that this might be not terribly overvalued, if it's overvalued at all. So in this market, this intrigues me because all of the stocks that I love, some of them on my watch list, some of them that I own, seem to be overvalued. So why is this one valued like it is? So click on the next slide, please. And I probably shouldn't admit this to the better investing crowd, but the price chart, I will look at the price chart. And so I have a big yellow arrow pointing at where the price went down. Well, what happened was in October, Tesla said, oh, by the way, on these 2 different models, we're not going to use Expel anymore. We're going to use a different product and do it ourselves. So they were trying to save themselves some money. It represented less than 5% of Expel's overall revenue, but you see the result of what's happening there. So if you're intrigued by this stock, you got to keep that in mind, and we're going to be watching, you know, how well they execute their growth strategy and if this is a trend. So that other automotive or customers or OEM customers are going to stop using the product and providing it, and stop providing it prior to the company, the cars or trucks eventual sale and delivery. So keep that in mind. How are they going to make money? They are going to continue to expand globally. We're going to see China in the mix there a little bit more. They indicate they're going to continue to raise brand awareness for those hardcore car enthusiasts, or maybe just the medium core car enthusiasts, with advertising, sponsorship, and so forth. They will continue to look at acquiring, directly acquiring, and working through installation facilities. And they have done a little bit of this very recently as well. They are going to continue to find uses for other film type products. So the architectural window film segment, they say, continues to gain traction. And I looked, and that's currently 17% of revenue. So not small change. And it is growing a couple of percentage points every year. Company guidance says they're looking for annual revenue growth of approximately 15%. So your spidey senses should be tingling here, because remember those numbers that we had? 35%, 30 quarter over quarter, and over the past 10 years, and they're guiding at 15%. So you can certainly put together a stock selection guide, but make sure you're conservative here based on what the company is guiding. They're not gonna, they might be under promising and over deliver, but they're not guiding at 35%. So things to make note of: keep an eye on those high PEs. Are they going to come down, or are they going to keep trading or in the 40s range on the high side, like they have been recently? Well, recently it's in the 31, but high side was 41 or 45, I think it was. Company guidance of slowing growth, and make sure those pre-tax profit margins continue to inch up and do not degrade if you're interested in this company. So otherwise, I'm intrigued. It's on my watch list. XPEL.
Very good. Thank you, Susie.
Thank you, Susie. Our next presenter will be Ann Manning, and Ann is going to talk to us about Paycom software.
Good evening, everyone. My first stock is Paycom. This is an Oklahoma-based company that provides software application to companies that helps their HR departments and their payroll work better together. They help remove all the data entry for the HR and the payroll departments. Since 1998, they have transformed the workplace by giving employees better direct access to their data in an easy cloud-based application. Next slide. These are the 5 areas that their software deal with. If you go to their website, they have a great presentation on their investor relations area. Time doesn't permit me to go through each one of those, but if you go to the website and look at this, each one probably has 6 to 9 different areas that they work on. But we're just going to look at the payroll area tonight, and I encourage you to go look at the other ones. Next slide. This is their newest application that they have. It's called Betty, and no, this isn't your Aunt Betty coming over to help you. This is for better employee transaction interface. This allows employees on their phone, their tablet, or their computer to access both their payroll benefits, their expenses, like their 401k benefits. They can see if their paycheck and their expenses are correct before a check is printed, and this certainly cuts down on any unnecessary corrections for the company. Next slide. These are some of the areas that payroll that can help payroll with. We've talked about the Betty, which is their newest deal, but you can also see the other areas. I was really interested in the garnishment administration. I would have never thought about this.
Wow.
But a company is liable. If they're supposed to be garnishing your wages, they're liable for this. And this software takes that away from the company having to worry about whether or not this is done right. But as you can see, there's quite a bit of different things that their payroll department can benefit from, and this has cut down tremendously on the amount of work that companies' payroll departments have to do. Next slide. one of the things that Betty has done is a double-edged sword, and it has the companies that are looking at it. They brought this out in 2021, and they really like it, but it has made some of the products that they were already using for Paycom outdated. The company feels like that they will come on board and this will not be an issue. But right now they're in a disruption area. This slide shows you what happened. This is certainly one that would get your attention, not something you want to see for a company, but it helps to know what happened. So in November, the company missed the analyst estimates on their sales. They rose 22% for the quarter, but their sales were at 406 million. The analysts thought it would be 411, so they punished them. Even though their earnings beat the analyst, their earnings were $1.77, and the analysts projected $1.61. So that was one area that they got beat down on because of that, which to me was a little bit of overreactions. It's not that big of a difference. The big blow came from the company, and that was when they lowered their guidance for 2024. They had been, as you know, has seen 22% gain in the third quarter. They're projecting now a 10 to 12% sales growth gain. Again, the market didn't like that, but we've already determined that companies like this new Betty, there is just a matter of it's going to be a transition period for them to change over to this new application. And the board of directors feels like that this is just a disruption, and this is not going to affect them going on. The stock price, as you see, went down to 146.54, but it's already has gone back up. So yes, it was a big drop, but they're acknowledging this and going forward. Next slide. Year over year, they had a 23% return in their revenues. Even though they are having this disruption with Betty, they're still making more than what they're projecting for this coming year. I personally think they are kind of lowballing their projections because they're still making really good money. Next slide. This is a lot of wording, but I highlighted two things here I wanted you to see. They have an annual retention rate of their customers of 90%. It's only down 1% from last year, which is really good. And their cloud-based software stores information for 6.8 million people from the companies that they represent, which is a 5% increase year over year. Next slide. Their financial ratios are great. Number 10 is only one that is slightly off, but it's nothing to be concerned about. This was a slide that I shared at the roundtable in February, and information comes from Morningstar. This was before I did this in February. They had changed their interface, and I had to go in and figure out where to find all this stuff. Well, when I went to do this for this presentation, they had changed it again. So I had to go back and find all this stuff again. So this stuff that's in the green here, that is where you will find all this information. And all of these numbers are trailing 12 months numbers. Next slide. As you can see, this company has, for the most part, up straight and parallel. They did have a dip in 2020 when we all know what that was for. But overall, they have done real well. Now, last quarter, they had a 17% return, and their Morningstar is projecting 11.2% for the next 2 years. I looked at all my usual suspects when it came to projecting my forecast, and that would include value line member sentiment on better investing, the company guidance, and manifest investing. And I decided to go with the upper end of the company's guidance, which was 12%. And I always go with 12 for both the sales and the EPS. Next slide. As you can see, their pre-tax profit and their return on equity is certainly in the areas that we want them to be. They're down just a little bit in the return on equity, but they're still doing great. They have a small amount of debt, but as you can see, they have a large amount of money on hand if they needed to cover any interest on any payments that they may have. Next slide. I did the 10-year PE charts. I wanted you to see they had some really high PEs in the last 10 years. But if you look on the right, on the left side, their 5-year average is 86.9, which is still quite high. But their current PE is 33.6. So they're definitely going down. Next slide. When I did estimating for my PEs, I was comfortable with the 38. I feel like that there are going to be taking a hit for a little while because of this lower guidance. So I did not want to put in a high PE. So you'll see it comes out to $393.80 as my high price. I went with would be 80% of the current price, and I believe the current price today was $204.52, but when I did this, it was more like $198. So that gives me a zone of a buy range, and even with the days going up to 204.52, it is still in the buy range, and it gives me a 4.7 to 1 upside down ratio. Next slide. This is an average forecast PE of 11.6, but I really feel like this is conservative. I think the company is going to do better than they think they are. The companies are really coming around to Betty and what it can do for them. It actually simplifies more for the companies than the software that they have been using. So I feel like this company will do much better, which will certainly make everybody a happy camper. I do not own this stock. This has just come to my attention recently, and it will certainly be on my watch list, and I would consider it a core company. Thank you.
Thanks, Ann. We appreciate your input. Matt Spielman is our next presenter, and he's going to talk about Perion Network. Matt?
Very good. Next slide, please. So when you have an assignment like this to be part of the stock panel, one of the first steps, of course, is to choose what you want to talk about. And there are 2 circles you can talk about, what you know or what might be familiar with you, and then what it might be interesting. There are a few places to go. The second session last night talked about several places to go for initial screens. One of them is shown here is the Better Investing Ticker Heat Map. So I'm looking for dark green boxes, companies that the community is, one, interested in, because these are the most searched actually the most SSGs submitted or done for a company, but looking for green for a positive view so I can give you all a good idea. We're not concerned about size or about industry because we're not really building a portfolio, we're just getting ideas. And as Mark circled there, Perry came to my attention because it was one of the few greens I wasn't really familiar with at all. Go ahead and give it a click, Mark. If you hover over the ticker and the heat map, you can get a little initial information with the company. So it's in communication services, obviously, which could be a lot of things, internet content, decent sales growth, but look at that EPS growth. That's amazing. And it was 270 people a week ago. Now 300 people have looked at it. So for what is likely a very small company, because it's growing earnings so fast, it has a lot of interest. Next click, please. So I took a look at the beginnings of an SSG form just to look at the chart, look at section 1 and see how it is. You can see it's a pretty shaky distant past up through 2017, but it looks like somehow they got religion in 2018. Give me one more click, please. So if we hide those first 4 years and look at the lines there, it looks very good. Now we actually have higher sales growth than was reported because we've taken out those first bumpy years, as well as pretty astronomical earnings per share growth. Very decent returns on sales and equity, again, in recent years. And somehow they're doing it while reducing their debt to capital, which is unusual for a small company of under 1 billion in revenue. At the bottom, I have just the top snippet of Perry's page in Manifest Investing. Thank you, Mark, for covering it. You can see, so the quality ranking is 61. It's a good, not great company in terms of quality, in terms of straight and parallel. Now, I believe that some of that is colored by those early years. I tend to have an affinity for companies that are sort of emerging into predictable patterns, or the patterns we like to see. So I believe that the quality ranking will go up as those early years roll off and as this good trend continues on. We'll see what happens. Next page. So that was Friday last week, and then Monday this week, as I was off to see the total eclipse, my broker news alert showed me that for some reason Perion was down 40% that day. I should mention one of the reasons why it was on the ticker heat map. I did find a recent, there were several, but there was one recent first cut study of the stock who mentioned that this was a pick in the Small Cap Informer newsletter in March. So thank you guys for having the panel today instead of a week ago, or I would definitely be in the hole. It could be an opportunity here. And of course, you have to wonder, does this mean I should drop this and go back to one of those familiar stocks, or could this be an opportunity? So looking at the meat of the matter on the right, I've highlighted what is really wrong, or why there's such pessimism there, was because Microsoft Bing changed its pricing, raised its pricing in ads, and it led to a decline in activity with Bing, which in 2022, I didn't highlight, it's toward the bottom, was 35% of Perion's revenue, although they have been diversifying away from it. So I'm looking to see if I know something happened in 2018 to make things better, and I'm looking to see what this really means and whether the market reacted appropriately or overreacted to it. Next page. So here's a basic background of it. It is headquartered in Israel. It does business globally, of course. It's an internet company. Founded in 1999, so think of it as sort of a child of the .com era. Changed its name shortly to Incredimail, so you can imagine what its first channel of advertising was back then. Public listing in 2006, changed to Perion Network in 2011, looking to diversify away from that single channel into multi-channels of online advertising. Here comes the first date. So Doran Gerstel was appointed CEO in 2017 and led a turnaround. It looks like it was a very successful turnaround, right? This could be the explanation for why the company has behaved so well, so much better since 2017. And he actually retired, and they just had a new CEO named in August 2023. Just 561 employees, under 200 are in Israel. There's a significant number in the US and a significant number in Europe. And those tend to be, if you see in the bottom there, a serial acquirer, those tend to be in place where the companies they've acquired operated. So they do not consolidate or bring things together. They operate in place whatever companies they've acquired. Next page. So this is a slide from their most recent investor presentation, showing in essence all the channels that they can address if you're working through them, they're essentially a middleman, right? So they do not own any internet portals or other digital medium. They don't have a product to sell. They are someone who helps companies run marketing campaigns across a number of platforms. And so that's not only your PC, whether at home it says coffee to start with, or in the office during the day, or your phone. That's also external things. So it can be on a various number of digital audio means. It could be what they call DOOH, if you look at the jargon decoder, digital out of home. So that could be digital billboards, other digital displays that you may find in public places like bus stops or in shopping malls, that sort of thing. And then at the end, when you're home in the evening, that CTV is not cable TV, but connected TV. Your smart TV has additional capabilities that allow it to target ads to you much in the same way as your other digital devices. Next page. So I'm going to go through these pretty quick just to give you some examples of what this is. It's not a product you can touch, but what do we mean by these channels? Here's one. This is a partnership with DirecTV where the ad actually comes up as you pause. So digital shows that are ad supported tend to have very jarring interruptions with ads. They don't really have scenes that end. They just kind of happen. This is a point when you pause it. Of course, we know that the show is ending because you've told it to end at some point, and it's making use of what would otherwise be dead space, just the still of the video, and helping pay for the service. You can see on the bottom a number of customers that are making use of this channel. Next page. This is not really a separate channel, but an idea of retailers and retail growth. So on the left is the retail growth market of media, of ad spending, and on the right is Perion's own growth, triple-digit growth. You can see, happened to be coincidentally, Charlene, I didn't know you had a history, but Kroger's ads with the animated folks as a significant customer in a number of channels. Next page. It's not just video, but it's audio too, as I mentioned. You can see here Pep Boys, as a customer mentioned, working across Sirius XM, Spotify, so not just music, radio, but also podcasting. Anything that's ad supported is just as digital as a web page that you have and can be targeted just as well. Next page. So this exemplifies an integration to Amazon. This would be similar to the integration they have with Bing. Again, they are not the platform. The platform provider has a way for people to come in, and you can see on the right, coming from Amazon, down on the left is a Perion Demand, is sort of their plug into Amazon, and there are other people you can work with as well, but it's the integration of multiple platforms, which is the value add that Perion has, and then more customers on the bottom. As the last example of this digital out of home, this is a bus stop. They have a significant presence in Brazil. They have presence in a number of other countries as well. Hong Kong is actually one of the biggest markets for this type of advertising. Being in a public place, having ads as you're passing the store, or with particular times, there might be with a dinner time, you might have an evening ad, that sort of thing. Going along with specific needs of advertisers in the proximity of that physical place. Okay, so that's the end of the channels. Now, this is a small company, so we still want to check our trusted data sources, and that can be difficult when you're looking at this small. First, on Morningstar. So on the left side in the Morningstar area is actually before this crash on Monday. This was actually Friday the 4th. Perion was trading at 21.42 at close with a Morningstar fair value north of $32. Now, this is not an analyst's opinion. This is an algorithm's output. The confusing part is, if you see the arrows across, that 21.42 had Morningstar give 3 stars, and of course it is a very high uncertainty, so it could be that wide. But then down below, they give a 5-star price of 21.65, slightly above the closing price there. So Morningstar is confused about this company too, and that wasn't even on Monday. Now, but to give the algorithm credit, in the after part of Morningstar, they did lower their fair value by a good third. But the price, of course, dropped even further away from that too. So you might say they hadn't updated the 5-star price yet, but you might say Morningstar thinks there might be a value there as well. Speaking of value, going to the right on value line, You can look up a data price there, but I have the red oval there because that would be normally where we would click to get our value line page downloaded for those who like to look at it old school, and it doesn't exist. It doesn't exist in the standard edition or the extended edition. So we're on our own as far as value line's done. But thankfully, again, it is in manifest investing coverage. As I mentioned, the quality is good, not great, but hey, it's there, so we can look at it. The par is astronomical, but I would say maybe it's a supplement. I said I thought the quality would increase as time went by. I certainly think that par will decrease, and you'll see here eventually what my opinion is. But I assume with news that's so recent, less than a week old, that par is still reflecting, let's say, last week's view of the company. And as analysts update their numbers and those propagate through the tools, that's going to naturally come down anyway. So I certainly on let's say day 0 or day 1 of an investigation like this, I don't believe that's the number even they really think. That's just old information. Next page. So this is back again from Perion's company presentation. This was the company guidance for 2024, given their results for 2023 at the fourth quarter earnings call. You can see they're looking for 17% revenue growth. That's great. They don't give earnings per share earnings, but adjusted EBITDA, that's a little bit less, 6%. If you recall from the earlier page, they had just completed an acquisition in Q4. So acquisitions often have costs that come out. So although that's not up straight and parallel, that should be a temporary change. And you can see on the right side where it says pro forma growth would be essentially without the acquisition, it was 10 and 10. Nice, up straight and parallel, moderate growth, not amazing growth, but we know they're a serial acquirer, so this acquisition growth won't be a one-time thing. They'll have to find more acquisitions, but they will continue to do that. Now, that the news about the impact for Bing actually came with updated guidance from the company. That's where I put it in red here. So obviously a significant drop, $250 million drop, a 20% drop in revenue versus 2023, and a 53% drop in adjusted EBITDA versus 2023 as well. We can expect, it's a point against the company that their channel partner can move this quickly and impact them. But it isn't to say that that's either permanent in the move or a permanent effect of it. You'll often see this with airlines, for example. One airline will raise their prices and they'll watch to see if everyone else raises their prices, and either they do and then they reach an equilibrium, or they don't, and the company that took the action has to lower prices to get back to market rate too. So we'll see where that is, but you can see with a 35% drop, or let's say a drop in 35% of the revenue, the net was 20% down in revenue from, as the company believed, from the move by Bing. Next page. Okay, so now we're going to do the SSG for real. So I've turned on the detailed estimates. Give me one click mark. What I did here is I changed the default estimates again, believing that the analysts haven't updated it, and I actually input under the data field. I've actually changed the guidance for 2024 to match the company guidance. And then even though earnings, as the company gave them, was adjusted EBITDA, I took the somewhat dangerous step to say it'll be a commensurate change in earnings per share as well. So that's 20% down in revenue and about 50% down in earnings. Looking at my projections then, so I'm giving them a 4% growth rate over these 5 years, which would not be enthusiastic at all. But again, that's from the 2023 level, not from this year's level. So I expect it'll go down and they'll grow quickly out of it at a rate of 10 to 15%. The historical EPS, I use the preferred procedure to work through that. Again, to be conservative in terms of what will this mean to lose this business with Bing and what will they do to adjust it. I assumed that this company, even though it's going to grow significantly, at least 25% over that time, that it would not change its operating margin. Usually smaller companies like this get a lot of traction in their earnings by improving their operating margin, getting better leverage out of their investments.
Come on.
I'm assuming that's flat here as a way to be conservative. And then we saw evaluate management. We talked about that earlier. Everything is green. Next page. On the back on section 3, they did have a dip in earnings, believe it or not, during the pandemic. I took those high ones out, but other than that, it's in the teens. It's not outrageously high PEs for a grower like they are. I would have maybe taken out the 5 low PE in 2019, except we're at 5 now as well. So leave the low, take the high at 15.5. Next page. Okay, I wish I could be Steve Jobs and leave this to the very end, but we're about to talk valuations. There's one more thing you have to know about this company. This $600 million market cap company has $472 million in its possession. Again, without debt and as a serial acquirer. If I take just that cash, not taking any receivables or any other assets, versus the total of its liabilities, it has 113 net cash, net of all liabilities. So almost 20% of the market cap, even in a very pessimistic view, is actually cash. And that'll become important in the next slide. So now we'll look at section 4. Again, the high price is pretty straightforward. 15.5 high PE times the high earnings per share is 41. For the low, I just couldn't find a low I was comfortable with. We're already at just about 13, just under 13. The average low over the last 5 years is 11.6. Well, first of all, doing low PE times the average low PE times average low earnings actually gave us a 20, so that's invalid. I could get an 11. I could think 20% below this gives me a 10. I just didn't think those sounded low enough, so I actually went full Ben Graham on this, and in the call-out box went to liquidation value. Now, they have a lot of cash. I actually believe their current assets their accounts receivable are very recoverable. They don't have product. This isn't last year's clothes that could get returned. This isn't a parking lot full of cheater diesel cars that might cost to dispose of. So I've taken its current assets, which is its cash plus accounts receivable, minus the total liabilities is a net liquidation value of the company, $367 million, divided by 48 million diluted shares is a liquidation value of $760 a share. At that level, I still get a buy, 5-to-1 upside downside ratio. Go next, one more click, and they'll be done.
Well, I was just going to say, Susie, I want to see this on as option E for low price.
Option E, the nuclear option.
The nuclear.
So 5C, looking at the compound annual return with a high PE, 25.8%. with a average PE 9.9%, which I think is still at the top end of the sweet spot for my par right there. Again, compare that to Manifest par 43.5. I think it's going to head more toward my pars, not my par, but the pars I have as the data updates as we get through there.
Probably relatively soon, yeah.
Yes, this is not a beginner's company. I apologize for beginners there. I do own it. I bought a little bit as I was investigating it. I was able to sell myself, if not convince any of you that it was an investment company. I would not consider this core at this time, right? It just had a negative shock. It's had 5 good years of going on. I do believe in the next 3 to 5 years, this could be considered a core stock.
Okay, thanks, Matt.
Thanks a lot, Matt. Our next presenter, I'm going to be the next presenter with Excel Service Holdings. Next slide, thank you. At a glance, Excel is a fairly good-sized company with 50,000 employees and $1.4 billion in revenue. We would classify it as a medium-sized companies, and the growth in the company is 18%. That's been pretty decent. What I like about this company is the quality of their customers. If you look at the collection at the bottom of this slide on the right, you'll see the kinds of customers that Excel attracts. Excel is in the business services industry, and that's a very crowded industry right now with companies like Cognizant, Infosys. These are companies that offer all different kinds of services directly to businesses, from call services to suggestions on how to become more efficient. Next slide, please. They operate in 2 divisions, the data analytics division and the digital operations and solutions division. And then they've divided the larger division into 3 categories: health, emerging business, and insurance. They do a lot of work for the insurance industry, and what they do in the insurance industry is they try to make the purchase and the granting of insurance much more smooth, especially for smaller companies. Next slide. Peak Matrix, the Everest Group, is a group that kind of rates these types of companies. And you can see by this matrix chart, you'd love to be in the upper right-hand corner of the chart. And that's exactly where Excel Services is. You probably recognize some of the competitors up there in that right-hand corner with it: Genpact, Cognizant, Accenture. I'm not sure what WNS is, but it's up in that upper corner, so it might be worth a look at all. I think that this chart has kind of pointed out a really great industry study for you to take a look at. There's 5 companies up in that upper right-hand corner that you might want to compare with each other and look for the best of the group. The Everest Group seems to think Excel is certainly one of the best, if not the best, in what it does. Next slide. The data analytics portion, which is about half of the business, and it's the part of the business that's growing the fastest, starts by gathering customer data. Look at this wheel at the very top, the 12 o'clock position. It gathers customer data, all kinds of data from the customers, no matter what the experience happens to be. It could be insurance, it could be healthcare, it could be media, all different kinds of data they will gather. And then they'll push that data onto the cloud and they'll structure it. That means they'll organize it into something that makes a lot of sense to their algorithms. They'll run some proprietary analytics on that data. In other words, they'll start to search the data looking for different kinds of trends, looking for different kinds of repetitive actions that are happening, things like that. And then they will come up with some insights that should help the business become more efficient, and they'll deliver those insights to their client. Those insights should improve the efficiency of the business, and then we start the cycle all over again, continually looking to improve the business by continually gathering more data. They employ 8,000 plus data scientists to help them. And what differentiates this company from all of the other business services company is that they've been talking about AI for the last 3 years. They've been talking about generative AI, and now they're talking about the next generation of AI, which is the stuff that we're hearing about with NVIDIA chips and all the stuff Microsoft is doing and that Google is trying to do and everything else. Keep in mind, Excel Services has been talking about it for almost 3 years, not for the last 3 months. Next slide. They have over 50 different AI solutions that are already deployed and working in the different ways that they deal with their clients. And here's some examples of them. They mine bank statements, for example, looking for trends, looking for things that are happening that they can perhaps automate or they can make more efficient. They're looking especially in the insurance industry because about 1/3 of their total business comes from insurers. And so they're looking for all kinds of ways to make insurance more efficient. They're helping new businesses in their underwriting attempts to not only get funding for what they want to do, but then to let that funding continue and to have it pay for everything they want to accomplish. All different types of AI solutions already deployed. Next slide. They have a lot of annuity-based revenue. In these blue bars, the lighter blue is the annuity-based revenue, and that revenue is under contract, long-term contracts, 4 or 5 years on average. So they start every year with 80% plus of their revenue guaranteed by contract. And then the rest of their revenue comes from projects that they engage in by shorter term contracts. Next slide. Here's the lines. It's not a very large company. $1.6 billion in sales puts it at the very small side of the medium-sized companies. And since 2017, we certainly have an up, straight, and parallel situation going on. There is no value line report for this company. There is no Morningstar analysis for this company. And there's very little guidance from the analyst community. My judgments are in line with the ACE values from the Yahoo site, but I will tell you that the analyst consensus group is not real large, which are generating these values for this particular company. I've leaned a lot on the historic growth, that growth of about 13% in sales and 26% in earnings. And I've chosen numbers which I feel are on the conservative side, the very conservative side. I've suggested that I might see 11% growth going forward in sales and 15% growth going forward in long-term estimates. I am getting some Morningstar numbers. These are not in a Morningstar report, but I am getting some numbers that are provided to Better Investing in the data feed that we buy from Morningstar, and those points that you see kind of hanging in the air represent the Morningstar next couple of years calls on where they think the sales and earnings will be. The evaluation of management comes down pretty nicely, a generally increasing trend in profits, a return on equity that in the last couple of years has been at 20 or more, and we know that when it hits 20, we're looking at a really top-notch company at that point, and debt to capital, which the company has been able to keep under that 33% benchmark that we use, and it's certainly in the last couple of years been coming down. It's trending downward, and that's a very positive thing as well. Next slide. The 5-year averages in the grid in the upper right-hand corner of the slide are 38.3 at the high PE and 22.7 at the low. I've kind of rounded them downward, and I'm using 32 going forward and 23 for my two values. And that gives me high price and low price. I usually choose choice A at $25 for the low price, giving me a buy upside downside ratio of 9-to-1. I'm very, very content with that par value of 15.5%. And I like to think of the range that I might get if I were to sell this stock in 5 years of somewhere between 15 and 19%. Next slide. That 15% compares, I think, quite favorably to the MyPar number, to the manifest number of 17.6%. So I'm getting validation for my analysis. If my number would have been very different from this number and the next number that I'm going to show you, I would have done some serious rethinking in my analysis. But I'm pretty pleased with this comparison of the 15 to the 17. I find them both in the same ballpark. Next slide. I don't think that being an early adapter to something necessarily makes you the best company in the field that you're looking at. But everything I've read about Excel services points to a very high quality, high growth company. And it's a high quality, high growth company that at the moment appears to have a leg up over most of its competitors when it comes to this artificial intelligence concept. The site itself, the website for the company, is crammed with explanations about how the entire company makes things work. And it's especially interesting to note that within the last 2 weeks, this company has laid off 600 people from their digital normal part of their business, and then rehired back 300 of those 600 people and put them into the AI part of their business, and then has gone out and begun to hire another 500 people in the AI portion of their business. They feel that's the fastest growing part of the business, and they're trying to keep their staff aligned with what the company is actually doing. The AI right now stands out as a way to differentiate this company from the competitors. Again, being an early adapter does not necessarily mean that you're the best, but at the moment, everything points to this being a very high quality company. I suggest you take a look at Excel Services, EXLS. Charlene Hansen is now going to speak to us about Graphic Packaging Holdings Corporation.
Well, I took a little different approach. You've done some great jobs with showing the, hold on, I have a phone call here. Ken and Mark do such a great job of showing how you can screen for great companies, but sometimes you might have a personal interest in something that's going on around you. And for me, it's, I just get real aggravated when I see how large our landfills are getting with plastic and styrofoam. And so I started looking at some packaging companies, and Graphic Packaging Holding Company came up. And let's see, Mark, whoops, is that, can you go to the next slide, please? I think here we go. No, go. Well, I think you missed part of my first slide, but whatever. It's a medium-sized company. I think you missed, something's missing from that front slide, but it's a medium-sized company. Sorry. The price is around $29 right now. The ticker is GPK. They're a global leader in sustainable consumer packaging. Next slide, please. They're located, as you see, North America and also in Europe. I was interested when I went to this into their website and found the fascinating technology that they use. Packaging is more than just the pretty picture that they put on the packages. It's all about how these packages function, the design research that they do. I highly recommend, if you're at all interested in this company, go see the video. You'll be surprised at what goes into this. Their market covers, of course, groceries, things you see and buy and take home from the grocery store, beverages, food service, which includes the doggy bags you take home from the restaurant, or places like Costco where you take their ready-made meals home. Also, they make household products, packaging, and for health and beauty care and pharmaceuticals. Next slide, please. Why I like this company so much is because they have a continued focus on renewable sources. They, in their Vision 2025, from they had lots of emphasis on going to paperboard manufacturing facilities, recyclable and sustainable products. Their latest annual report gives a vision for 2030, and they continue to focus on ways of getting rid of plastics and styrofoam and using more of the paperboard. Next slide. So onto the SSG. I took out the COVID years. There was some, they called it destocking issues. They couldn't get products, and then they got way too much products. But their sales didn't decline during that time. And so sales and earnings are both going up. You can see down below that it was, their history is 11% growth in earnings and 19, almost 20 in earnings. But the forecast going forward, and again, you can look at the little dots at the top, which indicate the data from analysts. It says CFRA forecast, but what that actually is, I looked for, and I got numbers from Morningstar, from CFRA, from Value Line, and also Yahoo Finance. Interestingly, Yahoo Finance gives a 5-year sales forecast of 25%, but I also got the forecast from the company, and if you look at the very top little dot, the farthest out. This is from their annual report, and they're looking for 11 billion in sales by 2028. So that made me feel comfortable with the 4% growth that I used for their sales forecast. And I just, again, put my forecast through the dotted lines from that information I got from the analyst. Next slide, please. Looking at management, I like the trends on both the pre-tax profit on sales and the return on equity. Their numbers are increasing each year and they look good. I gave them a little star off to, or a big star off to the right there. But when you look at debt, first you need to know that the industry as a whole runs very high debt to capital. Most of them are in over 55, 56%. A lot of them run in the 60% range. And this company has been doing it for years. But I did put a caution sign there, and I'm going to talk more about debt as we go a little bit farther. Down to looking at the PE ratios, and that little caution sign that's there was somehow a mistake. I think I was trying to get it placed on the other one. But if you can go up just a little bit, Mark, so you can see the bottom of that chart. I did look at the 10-year PE, and oops, can you raise that? Or oh, there you go. Thanks. That helps. I looked at the 10-year chart as well as the 5-year chart, and the high PE for 10 years was over 19%. But the 5-year average is 16.7, and the low PE is 11.4, and the current PE, which you can't see on the screen, or at least I can, is 12.2, I think it is right now. Mm-hmm. So it's pretty close to its low PE. So you can go to the next slide, please. So I use that average 14.9, actually use 14 as a high PE, which is considerably lower than what their 5-year and 10-year average is. And that forecast a high price of $50.04. And that high price compares to the value line, projected high price, and manifest high price forecast as well. I use 23 as a low price for a couple of reasons. If you use their average low PE, that low price I think is too high at $26.07. And their 5-year or their 52-week low was $20, and that's, again, you can't see that on the screen. So I picked something. Yes.
It is showing on most of our screens. It might not be showing on yours, but it is showing on our screen.
Okay. Yep, it's mine. I just minimized it a little bit there. Okay. So you can see the 52-week low is 20. So I went kind of in between and picked 23. I was comfortable with that number. So you can go to the next slide, please. I did compare this company with some other packaging companies, and I'm not going to go into that a whole lot other than saying that Graphic came up with the highest numbers of what I'm looking for with a count of 7, and they happen to be in the buy zone. The next closest company was Avery, which wasn't even anywhere near a buy zone. And the other companies do not have as much of an emphasis and focus on using renewable products as Graphic Packaging does. Next slide, please. On their annual report, they talk about what they see as opportunities, $15 billion addressable market opportunity. You can see some suggestions of where they see that opportunity coming from. Next slide, please. There was some operational information, and again, this is from their annual report. In 23, they had the acquisition of a paperboard manufacturing facility, which they paid $100 million for. They acquired Bell, which added 3 packaging facilities in South Dakota and Ohio, and that cost them $264 million. They also made some changes. They decommissioned a paperboard machine in Kalamazoo, Michigan. They are selling it's Augustus, Georgia, bleached board mill for $700 million. They continue to operate its bleached paperboard operations to focus growth investments on the expansion of coated recycled paperboard capacity. In November, they completed the sale of its Russian operations. They also have a share repurchase program, and they pay a dividend. In 2023, they repurchased over 2 million shares of its common stock. In December, at the end of their fiscal year, the company has available $565 million for additional repurchases. And in 23, the company also declared and paid dividends of $123 million, which is currently 40 cents per share annually. And the next slide, Mark. So let's talk about the debt. And my information came from Simply Wall Street. Some of you are familiar with that analysis program. And what they said is Graphic Packaging Holding has a debt to EBITDA ratio of 2.9, and its EBIT covered its interest expense 5.4 times. Taking this together, this implies that while they wouldn't want to see the debt levels rise, we think it can handle its current leverage. Importantly, Graphic Packaging grew its EBIT by 39% over the last 12 months, and that growth will make it easier to handle its debt. Graphic Packaging's level of total liability and conversion of EBIT to free cash flow definitely weigh on it, but its EBIT growth rate tells a very different story and suggests some resilience. Looking at all the angles mentioned, it does seem to us that Graphic Packaging Holding is a somewhat risky investment because of its debt. That's not necessarily a bad thing, since leverage can boost returns on equity, but it is something to be aware of. Next slide. So my summary is that with the forecast that I use, it comes out with a buy, a 3.8 to 1 ratio. If you go to section 5 on the SSG, the compound annual return is between 13.7 and 14.4%, and that's in the neighborhood of what Mark at Manifest Investing shows, a power of 13.8. I like the quality of this company being at 8. So I think there's lots of opportunities there. The club that I'm in, we just bought some shares of this company in our last meeting a week ago. And I also bought some for my personal portfolio, but we do not consider that a core holding. It's fall in the category of non-core. I think there might, I'm not sure if there's another slide. There is another slide. Here's what the analysts have to say about it. Value Line report, which just came out on March 15th, they said the company is well positioned to capitalize on the long-term secular trends that are impacting the industry. And that's people are getting really tired of seeing all the plastic and styrofoam that never is going to break down. The equity is ranked to outperform the market in the year ahead. Over the 3 to 5 year stretch, moreover, we look for the relative valuation to rise to more historical levels, which should produce good total returns for patient investors. And you can see on the right that there's several other analysts who consider it a buy opportunity. And that's my presentation of Graphic Packaging.
Good stuff.
Thank you, Charlene. Appreciate it. And let's wind up the normal presentations with nice ADR. Mark, go ahead.
All right, this is a company that I went looking for in much the same way that Ken has. It's a company that I'm almost ashamed to say I don't know much about until last night. This is the screen that came up as we were demonstrating last night, And I had been just scratching my head a little bit over the company, but NICE checks in with a projected low total return of 10, financial strength of A, and then I can't help but notice it is among the higher, in fact, it's the highest projected 3 to 5 year sales growth amongst this set of screening results from last night's session. Here's a little bit about the company now. Ambrosia is one of my favorite bands. You may remember the song Nice, Nice, Very Nice. And Ambrosia, just a fantastic band. But this is what they do. They provide cloud-based systems, enterprise-type systems and software that are based on customer engagement. Again, a call center, customer contact, and all that kind of stuff. And they also watch for financial crime and a very growing area of emphasis, compliance in financial institutions. So it is a leader in call centers, and they've been doing it for a while. I do find it interesting that the Motley Fool, by the way, that motto is pretty cool, pretty much rhymes with what we do. And interesting, Ken, that you were saying 3 years for your company, and I agree. They are an awesome consultant in the area using AI. I found information going back as much as 10 years for this company. They actually were out there implementing AI before it was cool, artificial intelligence long before it was cool. And I talked a little bit about this with Pat Donnelly. They are the real deal. They have been basically building solution-based systems for a long time. And they've been featured at the Motley Fool for a number of years, I believe, going back almost 10 years to the first mention. And what's kind of fascinating is some of the stuff that they're doing, they're actually driving competitors out of business. And they're basically crushing other people. And it's just a fascinating thing that these guys have been doing AI. I like to say Manifest Investing has been cloud-based since 2004, so no big deal. Same thing here. These guys have AI-based solutions that they've been working on for a very, very long time. I did watch presentations, again, going back 5, maybe 10 years, an interview with Jim Cramer and the CEO. The CEO is very impressive in an interview situation, and I would recommend that maybe you go to YouTube and just fire in the company name and see what you find. Here's a long-term price chart. You can see that they have taken a little bit of a breather here in the last couple of years. You're basically operating at a stock price that's comparable to the price achieved first about 3 or 4 years ago. So they have taken a little bit of a breather in their long-term price advance. Here's a look at what they do. I just love the quote from, that's from Margin Call, Jeremy Irons, and he says, in winning in the world of commerce, you can either be first, be smarter, or cheat. And he says, I don't cheat. And in this case, I believe this company is proving itself to be first and smarter. So you can see that they are very widely diversified across a number of businesses, many Fortune 100 customers, 8,000 employees spread all over the globe. Good medium-sized company at $2.4 billion in revenue and recognized as a leader. Just real quickly, core of their business and how they got launched is call center type stuff, handling customers and optimizing that interface with the company providing products or solutions. They have a really growing business in this financial crime. Think back to the stuff that we have witnessed over the last few years. Financial crime is not going away. Money's involved. And that we just sent somebody to prison for 25 years. There will be more. And they also do an awful lot of anti-laundering, money laundering and detection type stuff. And they work with law enforcement. So it's kind of fascinating to see where these guys are spread out. Much like Ken had to report, these guys are partners with some real heavyweights, very distributed around the globe. Working with all the big technology platforms, many of the consultant firms. I point out Accenture. Pat works for them. He's very familiar with this company, very well regarded. And again, you can just see the number of very recognizable partners that they have. Much like Excel, some of the best companies in the world. All kinds of logos that you would recognize on there. And again, doing some top-notch work over the last couple of decades. I did add the Detroit Police in here as some of the people that they work with. I'll just say that I've had firsthand experience with the Detroit Police. I don't need to go into why, but it's just fascinating. Some of the resources and advanced technologies that they have at their fingertips. No joke. Here is a look at basically the visual analysis for the company. I like it when the companies I'm looking at have an increasing quality profile. That just simply means the business is getting stronger. We also like to see return forecasts that are near all-time highs. So this is a company that has basically taken a breather, a bit of a speed bump in the stock price profile, while at the same time their operating results have not slowed down a bit. So again, our converting that to English, much as we did last night, this is simply a company that has gotten better and better and better on stock selection guides over the last couple of years because they are firing on all cylinders fundamentally from an operating characteristic. You're looking at a company growing at about 11%, generating very consistent 20-ish, 28% margins. Again, checking it at a real reasonable PE ratio, generating a projected return of about 14. You can see that the projected return on value for the company, which again is going to take into account the cash that they have in their checkbook, which is almost equivalent to the total liabilities of the company, much like the situation that Matt presented. This is very solid. This company has a 99% financial strength, very high on the EPS stability, and with a high quality rating, these guys are, much as we talked about last night, a very core candidate. Here's some of that other stuff that we talked about a little bit last night. As you look at that operating margin profile, that's pretty much steady as a rock. Same thing is true with the bottom line net margins. And you can see that the PE ratio has moderated but matured and is certainly hanging in that 20 to 25 range. Very nice. Well, little debt that they have is at basically a 0% interest rate, so somebody knows what they're doing. And again, Value Line checks in with a low total return forecast of about 9. Morningstar says that it's 10% on sale. The analyst consensus says it's 20% on sale. I just find this company to be fascinating, and the fact that they have really gotten out in front of this situation, doing AI and generative AI for multiple years is just kind of fascinating to me. So I do not own the company. I suspect that I will as I learn more about it if it continues to be attractive. So Ken, with that, I think we can move on to the rest of our presentations.
Well, let's zip through this lightning round, folks. Let's get people out of here in the next 20 minutes or so, okay? The lightning round is one stock each, and you have about 3 minutes to tell us the story about your stock. Let's start with Matt Spielman this time. Gentex, Matt.
Gentex, probably about the opposite of Perion as we come in. Core stock for sure, community favorite. It is in the automotive industry. The automotive industry is cyclical, full stop. Two things I would like to tell you about Gentex. So there's a big discussion in automotive right now whether electric vehicles are the future or whether the enthusiasm is moderating down. Gentex doesn't care. They all have rear view mirrors. There may be a very few cars who compromise their rear windows enough they need cameras, but those are more expensive and are more difficult to make safe, to work if something is compromised. And in that sense, that's the other strength that they have for their product. Based on, Gentex's main product is auto-dimming rear view mirrors, which by now are nearly ubiquitous. When they first invented them, they were a luxury item. They have a number of products outside of that, which build on their regulatory mandated position at the top of the window. That's an advantageous position for visibility of the driver behind them. It's an advantageous position for systems that may want to look at the occupants of the car, whether that's safety systems or entertainment systems. And it's a advantageous position for sensors that want to look outside the car, whether that's vision, radar, or LiDAR. The higher you are, the further your horizon is, the less likely you are to be obstructed. So this is going to be pretty straightforward. Looking at sales and earnings growth, Historical looks a little low, certainly for earnings. There's a dip down over the pandemic, of course. Automakers had supply chain issues, and so they produced less. But all the more reason that they are still even now catching up to fully populate any number of popular vehicles coming in. The sales forecast a little bit higher than the analyst 2-year earnings estimate, but in line with manifest and value line. And the earnings per share growth, again, done with the preferred procedure to follow up as if everything else is steady, follow on with is a little bit of stock buybacks. Next page. Looking at high PEs, again, for an automotive company, those are excellent PEs sustained through, even through the pandemic, not too high. They were hit a bit, but in line. I did take out 2021, the one started with a 2, but otherwise low to mid teens for an automotive company for a low is excellent, well regarded by the market. Straightforward, high and forecast low prices. I did use the recent market low as opposed to the low PE times low earnings, because we are at a 19 PE today, not a 14 PE, and low earnings if you're growing is the current year. So it gives it just a 3.1 to 1 buy ratio. This is 10% up since it was the focus of Stock to Study for Better Investing Magazine in January. Mark has an excellent sort of one-time slowly overview of analyzing a stock, which is based on Gentex, which should really walk you through it. So it's been up and down around the buy. It was 35.18 the end of yesterday. 35.50 is the buy zone. Not a rock bottom sale, but the good ones rarely are. Gentex is an excellent example of a core automotive company.
Okay.
Thank you, Matt. Anne, can you match Matt's timing? You got 3 minutes. Go. Inter Parfum.
Okay. Mine, Inter Parfum is a perfume company that is based in Paris and New York. These are all the brands that they carry. Obviously, they're very high-end perfume companies. They manufacture and distribute all of these perfumes through license agreements with the brand owners. They lease their manufacturing plants, which helps them not to be capital intensive. And they also work with over 100 subcontractors who basically do their packaging as far as their bottles, caps, and cardboard materials. To give you an idea, Jimmy Choo is their 17% of their company. They had a 19% over growth change from 22 to 23. And Jimmy Choo showed $227 million in perfume.
Wow.
They're not a large They're not a large company. They have $1.3 billion in sales. They had a 21% growth last year. And they are the top perfume manufacturer in the world. Next slide. You can see they have grown through acquisitions through the years, and they've had Jimmy Choo since 2009. That was a hard one to say. And so you can see they've gotten better and better as they have gotten more and more acquisitions. Next slide. As you can see, except for COVID year, they have been pretty much up straight and parallel. Last year, last quarter was 5.8%, but I projected 9 for both sales and EPS, and that's kind of in line with the trend line. I actually think that was a little bit too conservative. I think you maybe could go up to 11% growth on this. Their pre-tax profit and return on equity is doing well, and their debt to capital is fine. And their debt, they have a very large interest coverage for such a small company. Next slide. As you can see, except for 2019 and 20, their PE ratios are pretty consistent. So I felt that was, I could go with their averages for my projections. Next slide. As you can see, I have a 241 $1.20 for the high, and I chose the 119 for the low, and this puts us in the buy range. When I did this, I believe the price was around $131. That was last week. Today's price was $128.68. So this certainly puts us a good point in the buy range. Next slide. And like I said, I do believe I was a little bit too conservative on this. I think you're certainly would be more than the 11 to 14% range that they're giving here for projections. And I think this is probably a company you've never heard of, but they seem to be well run. And I think their owner is one of the richest men in the world. So he must be doing something right. So you might want to put this on your watch list. How was that, Ken?
Great job, man. Great job. Okay. Susie, where are you going to come down on the 3-minute time limit? Double Verify Holdings.
Yeah, Double Verify Holdings. Ticker is DV. Next slide. This is the one I'm more intrigued by. So this is another company, much like Perion, that's in the advertising technology space. And they've only been trading for about 3 years. Their growth rates are impressive. And how do they make money? Why don't you give us a click and show us how they make money? So small company in the software application industry, and they measure digital media. They provide analytics. So it goes without saying they have been working AI into their business. They have a product called Authentic Ad that makes sure the digital ad was delivered in a brand safe setting. So that's code for not on a porn site, if you're wondering what that means. And by a real individual, not a bot, and in the expected geography. So people who are spending a lot of money want to be part of this product, spending a lot of money on advertising, because they want their ads to go to the right people. And that's the short answer of what they do. Morningstar Financial Health grade of A, small company, about in the mid-range of our small company range at $573 million in the last year. Go ahead and click 2 clicks. One more. So what they do is media safety, reducing media waste, which is meaning they're helping advertisers create the right content for the right audience, protect the brand equity, making sure that the advertisements are shown on appropriate sites, not just not suitable for work sites, but ones that, automotive advertisements go on automotive sites, for example. It's not just a mishmash of the bottom of every recipe page in the world now has every advertisement you can imagine. So they protect against that, and they just want to drive better outcomes for advertisers, and bigger advertisers are more intrigued by this. Go ahead, next page. So the revenue model, 92% comes from the advertisers, and they are also involved in advertising on social media and that CTV that Matt mentioned. They measure post-campaign. They have a program going on with NBC to make sure, to see whose advertising works best on some of their programs and so forth. Then they work with the publishers. So the advertisers are the people who spend money on the ads. The publishers are the ones who place the ads, if you will. So there is a subscription component that the publishers can access that ties in neatly with this. Next slide. Evaluate management looks good. I will say return on equity looks low, but is increasing. So let's see how that runs for the next year or so. And then again, their liquidity ratios seem to be pretty good. They have very little debt. Huge PEs. So just take a big deep breath. I am not doing an SSG for you. Just bringing the idea. Yes, go on. Moving on to price. Okay, big drop. So what happened there was that one of their competitors reported that they had some issues. The company reported fourth quarter results and provided some guidance that were below expectations. They were not multiple percentage points below, but they were slightly below expectations. In their last quarter, they beat, and gross margin actually improved. And there were concerns in the industry that their competitor, Integral Ad Science, ticker IAS, also gave weak guidance and spoke of pricing competition. But this company, DoubleVerify, responded in their call that they didn't see any pricing pressures and their margins are holding up. So it's a wait and see story, and the stock might be at an attractive price since it's dropped, that you may want to consider it. Again, speculative. I do not own it. It's in my watch list and I might pull the trigger, but don't know yet. And DoubleVerify, DV.
And it's back at the IPO price.
Yeah, pretty much. Pretty much.
Yeah. Shar Hansen on holdings. 3 minutes. Go, Shar.
Sorry, I'm ready. On holdings, it's a consumer cyclical. It's footwear and accessories. It's a Swiss company founded in 2010, but it went public in 2019. And it's designed primarily for sports. The majority of the sales come from North America, but are sold internationally. Next slide. You might not have heard of ONON, but have you heard of OnCloud shoes? If you haven't, I strongly recommend that you give them a try. I now have 2 pair of them. I absolutely love these shoes. They're the greatest fit ever. They're very comfortable, sturdy, supportive. Yeah, I think they're stylish. If you see this strange little logo that's down in the corner, I have no idea what that means, but it represents OnCloud. It has a very interesting startup story. I won't go into it. Go to their website. You'll love it. We used it in our company or our club to do a challenge to Skechers, which we own. And I'll get into more of that later. Next slide, please. Oops, I'm going to see if I can move this. There we go. So as you can see, this is newly public company. It's had just fantastic growth since they went public. They have high forecasts going out. Morningstar created the numbers, the future growth in sales and earnings. So there's lots of potential there. If we go to the management bottom part, their pre-tax profit and earnings return on equity are going up consistently. Well, the last 2 years, it's a good trend. 2021 was a bad year, but that was when they were very early on. And it shows 17.6% of debt to capital in 2023, but from their site and other analysts, it says they are actually debt-free, contrary to my other company. Next slide, please. You can't use the PE. You can see how sky high they are. They're kind of outrageous. So knowing that that's going to come back in line somewhere in the future, I kind of arbitrarily went with a 40 PE, which generated a high price of $64 5 years from now. And I selected $22 as a low price, which is just slightly below, let's see, where am I? They're slightly below what their most recent low price has been. The compound annual return on the SSG ends up being 14.5%, and the upside down ratio is a 3.1. So it's just on the cusp of the buy zone. Next slide. To buy or not to buy, I absolutely love these shoes, and I love the growth potential. They have a flawless balance sheet with high growth potential. That's from one of the analysts that I don't recall which one now, but Manifest Investing gives a quality of 72, which I would like it to be a little bit higher, but that's not bad. PowerPoint was 9.7, so we're a little ways apart on my compound return and what Manifest has. Yahoo Finance, 16 out of 20 of their analysts give it a strong buy. NASDAQ's a strong buy. Zacks is a hold. I like the potential of on holding. Our club elected to remain with our tried and true Skechers. However, personally, I stuck my toe in a little bit, no pun intended there, because I love these shoes. And our club's motto is to learn, have fun, make money. And when you can have new company presentations, that's just part of the fun. Thank you.
Thank you, Shar. Let's see what I can do in 3 minutes. Okay, Mark, give me a click. United Health Group is the largest insurer in the nation. You all know the insurance part of United Healthcare, but did you know they owned Optum as well? Many of you use Optum Pharmaceutical or Optum Health as your healthcare provider or your pharmacy provider. And together, these two companies are a huge, huge, very successful health group, dealing mainly with insurance, but a lot of side businesses. 440,000 employees.
Wow.
Next slide. They do a wonderful job on their website of explaining what their goals are, or how they're going to reach their goals. And they've broken their business down into 5 areas of concern. You can read them for yourself, and they're going to tell you on the website about how many consumers they're going to touch with these different values, these different parts of their business. And then they're also going to tell you about how they're going to improve the business model for each of these parts of their business. Range from traditional healthcare benefits, things like Medicaid, Medicare, to pharmacy services coming from Optum Pharmacy. Next slide. The long-term financial performance outlook from the company itself. Earnings per share growth of 13 to 16%. Fantastic earnings growth for a company this size. And again, go to their website if you're interested in UNH. Look for the Investor Conference 2023 booklet. It's crammed with all kinds of easy to understand information about this company. And it's one of the most comprehensive collections of material about a company that I've seen on a website recently. Next slide. Look at those lines, up, straight, parallel, and look at the projections given to us by Morningstar off into the future. Also look at the fact that the red tick mark in the most recent I-bar is at the very bottom of the I-bar. This company is trading at a 52-week low, and it's trading at a 52-week low, and I'll give you a good reason why. We have 2 insurance agents in one of the clubs I belong to, and both the insurance agents tell us this is the typical April dance that goes with large insurance companies. They tell Medicare and Medicaid how much money they want, and Medicare and Medicaid says they're not going to get it. And then the stock price goes way down, and then they argue and they dance for a couple, 3 months, and then it all settles itself out with the companies getting more than they're being offered right now, and Medicare settling for a little bit less in cuts than they're actually going to ask for at the moment. Our insurance agents feel that this is a wonderful buy at this particular price. The RSI, the relative strength index for this company right now, is under 30. I've predicted growth of 10% in sales, 11% in earnings, and that's right smack dab in the heart of all of the analysts' opinions. Next slide. I'm getting a 13.2% par, a 16.3% total return. Again, I like to think of that as a range, 13 to 16% every year for the next 5 years. If I sell it in 5 years, I'm very happy with making my 13.2 look like the 15.3 in United Health Group from Manifest Investing. I think that that's validation for my study when those two numbers are so close. And here's more validation on the next slide. It's coming from Value Line. And I wanted to make a point about Value Line. This is an old Value Line. There'll be a new one coming out on about a week for this company. And when you're looking at an old Value Line, look at the price on the Value Line. It was $521, and today's price is $459. That's about 12% lower than the report. When you're looking at that kind of a drop, and then you're reading the projections that I've circled off to the side, keep in mind that if the price has gone down that much, the projections off to the side are probably higher. If I'm looking at, instead of 8 to 13, maybe 9 to 15 or 10 to 15, then I think my 13% is very comfortably right in the middle of that range. And again, I'm getting validation from a trusted source. I think you should take a deep, serious look at United Healthcare, the largest insurance company in the nation and one of the most successful.
Good stuff, Ken.
We're gonna end in Disneyland. Mark, go.
Yeah, that's the reason we adjust that Value Line total return forecast every day with changes in stock prices. I'm actually going to call an audible, and I want to go with Emergent Biosolutions. If I liked it at $86, I got to really like it at $2, right?
Is that
Mark,
in
do
coverage?
Disney. Disney, Mark. Okay.
I'm joking. I'll stick with Disney. All right, Disney. Very, very simple story here. They have been kind of messing up. The sheriff came back into town. He's back in the chair. They had just resolved their differences with the local government, and they appear to be doing a lot of things right. This is a company that has been long held in high regard by many of us. They have a substantial, wonderful collection of resources they can lean on going forward. I don't think this is a company headed for the crypt. I do see this as a turnaround opportunity. We did own this in the past. We sold it many years ago. My daughter actually cried herself to sleep that night at the club meeting. But I do think what we're seeing here is a company that is reversing. I think these numbers are low. I expect to see the quality turn and go back the other way with some of the stuff that they're going to be doing. Again, they have huge reserves and resources at their fingertips. One of the reasons that I was led to this company is I was searching for companies that were possible launchpad candidates. Launchpad, as we define it, is a company that is expected to have incrementally higher earnings in 2024 versus 2023. That's what you're looking at right down here. We're going to talk about this during our next roundtable with the St. Louis chapter. So this is an interesting situation. Obviously, they had a period of turmoil. They made some questionable decisions, but I see a company that could realistically jump on that rocket and head back somewhere towards these levels. Value Line thinks it's going to do it. I think some of the changes and operational adjustments that they're making make that possible. So I just think Disney is a turnaround opportunity. It might take a couple of years to really take hold, but they're headed in the right direction already. So good stuff at Disney, and I do not own it. I would generally have considered it a core holding in the past, but it really has kind of slipped into that gray area between core and non-core because of the operational damage done over the last few years. That's it for me, Ken.
Well, thanks for joining us tonight, folks. Your participation, messed that up, didn't I? Your participation sparks our enthusiasm. We stay enthusiastic as long as you keep coming to these events. Thank you so much for being here this evening. And we're going to sign off as the two guys who talk stock, along with a lot of our friends.
Is that our Huron Indian name?
That's our Huron Indian name, the two guys who talk stocks. Okay. All right. With that, good night, everybody. We're glad you came, and we hope we see some of you at the bull session next week and at the round table at the end of the month. Good night.
Ken, I did
Good
want
night.
to make one
Thank you.
last thing to point out. We are going to be talking about the consulting industry study at a future bull session. That may be very interesting based on the stuff we've been kicking around here over the last couple of days.
Great, great.
Thank
We have so much fodder for our bull sessions, Mark. We can do one. We're not going to do one a day, but we could do one a day for the next 3 weeks. Okay.
Very true.
Good night, everybody. Thank you so much
Thank
to
you all.
Susie and to Shar and to Ann and to Matt and Mark. A big thank you to you for all the work that you put in for the Mid-Michigan chapter. Thanks, guys. Thanks, audience. Good night, everybody.